First of all, the entire what's called the extended supply chain is much, much longer than people realize, number one.
Correct.
Number two, every spot on that supply chain has its own supply chain of inputs and outputs so that they can hold up the impact on the economy. It links very quickly to the monetary economy. We can talk about that as well. We have inflation. Everyone sees it. You got a Ford F-150 pickup truck, and it used to be $75 for a tank of gas. Now it's $150. Well, the demand for gasoline in that situation is what they call inelastic, which means you got to buy it no matter what the price is. You don't like paying the higher price. You see it. You see inflation at the gas pump. You got to buy it because you got a business to run or errands to do or whatever the case may be. But what it means is that in that example, that extra $75 to fill up your tank twice a week, let's say, so $150, that comes out of something else. You're not going out for dinner. You're not buying a new dress or a new suit or a sporting event or a concert or whatever it may be. So there's demand destruction. It may not be at the gas pump, but it's in everywhere else in the economy.
Correct.
So you get into these ripple effects. So the supply chain dysfunction, which in my example shows up in the form of higher gasoline prices, then ripples throughout the entire economy. Right. So the impact is enormous. Everyone looks at the war in Ukraine and Russian sanctions, and that made it worse. And then they look at the pandemic and the pandemic panic and the fascist public policy that came out of it. Well, that made it worse. But it really started, you can trace it back to the Trump tariffs in 2018, because I found some research on cargo shipments, because there are all these vessels, again, you know this from your experience, Robert, oil tankers, dry bulk carriers, other kinds of, container cargo ships, et cetera. We know where they all are, they all have GPS, unless you're a couple of pirates here and there, but basically we know where they're leaving, where they're going, what they have. It's all publicly available. And this one researcher tracked it, and she could show the breakdown beginning in 2018 with the Trump tariffs. Well, China, U.S. and Brazil are the two biggest producers of soybeans. China is the biggest importer of soybeans because they need the protein and they don't have that much. And so China was buying their soybeans from the U.S. because they're like, hey, this is one way to kind of balance the trade with the U.S. The deficit won't be quite so big because we'll buy their soybeans. Well, when Trump throws the tariffs on China, China says, we're buying our soybeans from Brazil. And they shifted all those purchase orders to Brazil. Well, that's not a phone call. I mean, you got to reroute vessels. You got to expand port capacity. Right. You got to get transportation lanes from the farmers to the ports, et cetera. And the people who do that, the real people, real companies, they don't want a 6-month deal. They want a 5-year deal. So that was all done. But you've now scrambled vessels all over the world, changed, port entry and embarkation, et cetera, on like a 5-year basis. And so they're now, China's getting their soybeans from Brazil. What's the U.S. doing with all the soybeans? Well, we looked around and said, well, the Netherlands needs them. So we're sending them to the Netherlands. Well, again, you got to scramble vessels. You're not going through the Panama Canal anymore. You're coming out of the port of Houston, et cetera. So it's a concrete example of how, the eggheads sit in Washington and say, throw tariffs on the Chinese. But now you're scrambling global trade. That has, again, as I mentioned, taken 30 years to build. And the same thing's going on with semiconductor sanctions. And again, COVID made it worse. Pandemic made it worse. And Ukraine made it worse. So we are where we are. But that's really the point. It's a complex dynamic system. If you want to take a big picture perspective, it's hard to get bigger than the supply chain because it's kind of everything. But to Kim's point, as I said, there have always been supply chains. There will always be supply chains. But they have certain members, partners, transportation lanes. There's certain kind of rules of the road, for no pun intended. A few other countries will trade with each other because we're not enemies. But China's going to be on their own. China, and by the way, people say U.S. is decoupling from China. That's true, but China is decoupling from the U.S. This is mutual. This is like a bad breakup, and China wants out as much as we do. So, but China is going to have to figure out its own supply chain. Who are its partners going to be? Well, they'll get natural resources from Africa and outsource their manufacturing to South Asia. So life will go on, but it will be much less efficient, but more resilient. And that's the trade-off. The reason things are breaking down is that Once the science kicked in, the math and the AI and the computing power and all the things I mentioned, what was the goal? What were they trying to do? Well, they were trying to lower costs. So we'll outsource to China because labor costs are lower. We'll basically get our natural resources from some other place. There's something called cross-docking. What's cross-docking? Well, it's when like a truck shows up at a warehouse. They used to unload it, put it in the warehouse, and put it on another truck. The Fed, at the height of the pandemic panic, going back to 2020, the Fed's balance sheet was up to about $9 trillion. I had to get used to saying trillion instead of billion, but about $9 trillion. And it's come down a little bit since then. But people say, well, wait a second. How can there be a dollar shortage or a liquidity crisis when the Fed printed $9 trillion? Well, the answer is you have to understand how the money system works and where real money creation comes from. And it does not come from the Fed. And here's why. The Fed did print the money. That's real. But the way they do it, the Fed buys bonds and treasury notes from the primary dealers, from the big banks. And they call up and offer me a 10-year note. Okay, here's the price, done. So where does the real money that powers the economy, if there is, if it does at all, where does that come from? It comes from the banks, because the banks can do the same thing. When the bank makes you a loan, what do? You're a business, you set up a checking account. They say, okay, here's $1 million loan. They put the $1 million in your checking account. Where'd that money come from? They just said you got the money, right? And so they have an asset, which is a loan from you with a note, and they got a liability, which is your deposit. So banks create money kind of the same way the Fed does, except it's supposed to be in private commerce. And that money actually can go somewhere. If you're a business, you got a payroll, you got to buy stuff or invest stuff, et cetera. But there's not much of that going on. Velocity is very low. The turnover of money is low. The M1, M2, those are different forms of money. I love the fact that the Fed has M0, M1, M2. It shows they don't even know what money is because they got 3 different flavors. But the point is that hasn't really been going anywhere. Now, but here's the key. $9 trillion on the balance sheet, maybe, 5-6 trillion today. It's a lot of money. But the notional value of derivatives off balance sheet of the banks is $1 quadrillion. And for listeners who might not have heard the word quadrillion before, 1 quadrillion is 1,000 trillion. So your 9 trillion at the Fed doesn't get you very far if you have to support $1,000 trillion worth of derivatives. And how does that work? Well, the answer is mostly the banks doing off-balance sheet swaps and swaptions and other futures and forwards. And, we don't have to go down the whole litany of names with either each other because they're trading firms, or with hedge funds who want them for speculation or hedging, or sovereign wealth funds or other institutions. There's a whole network of participants. But these are the big boys. These are the trillion-dollar institutions, the BlackRock and the Temasek and the Sovereign Wealth Fund of Norway. These are the big players involved in this market. Okay, so you have $1,000 trillion of derivatives off balance sheet. By the way, you will not see this looking at a bank balance sheet. You got to read the footnotes. You got to know what you're looking at. How is that supported? Well, it's supported with collateral. Not 100%, not even close, but maybe 1%, 2%. You got to put up some margin money to be in the game, but then you can have a lot more off balance sheet. Okay, so what's the best form of collateral? Well, it depends. Whether you're in a liquidity crisis or not, whether people are feeling confident or are worried, whether they think things are going to go great or start to collapse. So as things get more difficult, and that's the phase we're in right now, the quality of the collateral has to go up. So the banks are now saying to each other, I don't want your mortgages. I don't want your stupid corporate bonds. I don't even want 10-year treasury notes. Get me bills, treasury bills. These are short-term, very liquid, 1-year maturity or less. A lot of them are 4-week bills, 8-week bills, 6-month bills. These are very short-term, very liquid. They are the best collateral there is. And the banks are saying to each other, that's what I want. Okay, so now you're Barclays Bank or Deutsche Bank or Unicredit, Credit Suisse or bank, some major Japanese bank, et cetera. Where are you going to get the bills? Well, you got to buy them from a dealer, or you can buy them at auction. The Treasury has auctions, or you can get them from the Fed. But to buy a dollar-denominated Treasury bill, you need dollars. So that's why the dollar is so strong. Everyone's like, hey, Jim, we got these huge budget deficits and $1 trillion of expenses and bailouts and handouts and, 131% debt to GDP ratio, $31 trillion in debt, et cetera. How can the dollar be so strong? Well, the answer is, it has nothing to do with everything I just said. The dollar is strong because everybody in the world needs dollars to buy treasury bills to prop up the balance sheets of the 1 quadrillion of derivatives that nobody can see. And this is real. This is way behind the curtain, Kim. This is real inside baseball in terms of how the international monetary system actually works. So the strength of the dollar, which by the way is a headwind for gold, the euro's down, sterling's down, Swiss francs are down. Gold hasn't actually gone down a lot. It hasn't gone up a lot, but it's holding its own. But a strong dollar means anything denominated in dollars is going to go down, because if the dollar gets stronger, the dollar price of the commodity gets lower, or at least doesn't go up a lot. Okay, so first of all, you got a mad scramble for dollars. Why? To buy treasury bills. Why? Because they're the only collateral to prop up everything I just described. Now, but there's evidence of this, and again, you have to know where to look. So right now, the Fed has what they call the reverse repo program. What is that? Well, any bank, any major institution that wants treasury bills can call the Fed and say, give me some treasury bills, and you give the Fed cash. It can be overnight or a couple of days or whatever. The Fed pays you interest, so you're making a little money, but they send you the treasury bills. Well, why isn't that the solution? Why doesn't that work? Well, the answer is you can do that, and you can get those treasury bills, but you cannot rehypothecate them. You cannot pledge them to anybody else. You have to keep them, and the Fed might want to unwind that at any time. Well, that's not good enough. Can't get a loan. Interest rates on credit cards go up. Interest rates on mortgages go up, at least initially. But where it really comes home is that, okay, that's the initial stage. A lot of people don't understand that interest rates peak after the recession begins. It's a lagging indicator, because as you go into the recession, people are like, hey, I don't want to lay people off. Unemployment is a lagging indicator, because people, they really don't want to lay people off. They will if they have to, but that's like the last thing you do after you've cut out a lot of other stuff. So people look at unemployment's low and interest rates are high, everything's good. No, these are the things that turn around after the recession.